Okay, everybody, this is being recorded on the bearish risk reversal. This is number 8 of our course on roadmap to trading options. And the difference between this one and the ones that I've done in the past is that we are building this out like we would go through on our daily process, right? Well, you don't usually just come up and say, you know what, I need to put on a bearish risk reversal. Well, actually, if you watch the daily market commentaries, I do sometimes do something similar to that where I need to add negative deltas to my portfolio. And usually a lot of us have portfolios of stocks, and that is very delta positive. So in a time like this where we've started to see maybe the market start to correct, this could be a good time to add some negative deltas to a portfolio, whether it's with the bearish risk reversal or what we talked about last week in the synthetic short stock, maybe even selling some calls against something or buying puts, depending on what is going on around that underlying we've come up with a bearish assumption in. All right, so ultimately we have an idea where we come up with this bearish assumption, whether however you come up with it. Maybe it's a candlestick pattern, Fibonacci, the Ichimoku cloud, which I don't really use, but and maybe even saying it completely butchering the name. But anyway, you get my gist, is we come up with a bearish assumption in something, and we need to figure out what is the right strategy for that. And what I mean by that is we have the environment, which is volatility. We have days to expiration. We need to understand whether or not we're going to be buying a bearish option strategy or selling something for a credit. Well, this is how we're going to go through this process and kind of like building out a roadmap. When we go on a road trip, we usually spend a lot of time planning that trip out. As a matter of fact, most Americans spend more time planning a trip than they do their finances. And this is kind of a play on that, where we need to spend some more time on building our road trip or our roadmap on our journey here to finding the right strategy. All right, let me get a couple things out of the way real quick. My name is Eric Wilkinson. For some of you out there that may or may not recognize me, where I've done mainstream media such as CNBC, Fox Business, Wall Street Journal, things of that nature. I've talked about everything from economic to geopolitical and my market analysis on top of that. I actually started out trading in college with some money I had earned and was trying to get a psychology degree, decided I wanted to trade for a living, switched it over to finance, moved to Chicago after graduating with that degree, and walked onto the floor of the Board of Trade. Didn't actually even need the finance degree. As a matter of fact, I say that my psychology aspect of my education was probably more important than the overall finance in regards to just trading. A lot of actually the guys on the floor would ask me what those economic data points really meant, which was kind of funny that I was the new guy and telling some of these veterans what those numbers meant. I've traded everything from, like I said, stocks, financial futures, commodity futures, currencies, and options on all these products and just about all of these market conditions. You can follow me on Twitter at Wolfman's Blog. That's me personally. Our parent company is at ProTraderStrat. Also, Facebook, we have all kinds of content we're throwing out there on a daily basis to you guys so that you guys can educate yourself in a lot of different ways, whether it's if you want to learn how to chart or just trade options, you'd be following me there. But ProTraderStrategies.com on Facebook, you can get a lot of free content there that we can take advantage of. All right, this is the bearish risk reversal, all right? But one thing I want to talk about, like I mentioned at the beginning, let's take that out of our heads, put it on a shelf for right now, and really build this strategy out where we are coming up to the bearish risk reversal based on the environment around this underlying that we're somewhat bearish in, or that we need to be bearish in. All right. All right, so let's go over our roadmap key. We got to learn how to read the roadmap, right? So with that, there's usually a little insert down at the bottom, tells us what the streets are and whether it's an interstate or a side road or even a dirt road in some cases. But that's the same thing we need to know about options is these Greeks. I hope it doesn't turn anybody off right away. we're going to be talking about the Greeks here for the next probably 10, 15 minutes. The reason why is it's super important to understand these to trade options. And with that being that important, I've come up with some really easy ways to remember what these Greeks are telling us, all right? So don't just let your head just kind of tune out right now. Let's put our thinking caps on and we'll get into it. Delta. Delta tells us what that number on delta tells us how it's going to affect our overall premium for $1 move higher in the underlying, okay? So all of these are assumed one move forward or one move higher, okay? And we'll talk about the negative aspect of those as well. But delta tells us what happens to the options premium on a $1 move. So when we're looking at something like this, we are just pulling up TLT, and this is a relatively older example at this point, but it's a little easier for me to draw on this than it is on my actual trading platform. It just, I think it's a little smoother. So with we're talking about delta here, and we're talking about a $1 move higher, okay? So $1 move higher, which means that this number is now, we go to from 167 to 168.13, all right? So exactly $1 higher, all right? We're trying to, you know, compare apples to apples here and really nail it down. So just that price moved up by $1. What would happen to our overall premium? Well, what we want to do is look over here in the delta column, right here. The delta column tells us, you can see there's all different numbers. So let's just cherry pick one of these strikes, and I'm going to go with the 168s because I usually look at the ones that are just out of the money. We can see it's 45 cents, all right? So $1 move higher in the underlying, well, those premiums will move up by 45 cents here. So on that, we would have a 289 on the bid. The offer would then, you know, all else things being equal, we would have a 298 offer, all right? You know, and the mid-market would be somewhere, you know, relatively equal to that move higher. On the other side, we've got the puts. You can see the puts, though, are all negatives, right? Because it's assumed $1 higher. If those puts get further out of the money, they lose value, right? So we know that. Well, these puts that are just out of the money, let's stick with the 168s. Those puts would then move down by 55 cents for that underlying. So what we're looking at here is these would go from 345 losing 55 cents. We're talking about a 290 bid, right? $2.90 bid, and the offer would go down by 55 cents, and they would be $3. Okay, so they decrease as the market goes up and away, right? Because puts are bearish, we know that. Vice versa, if we went down by $1, if we can think about this, now we got a negative dollar move, so negative $1. Then those premiums would decrease by that corresponding amount, all right? So on the calls would decrease because a negative 1 plus a positive delta makes that a negative delta to our position. So those would decrease. Vice versa, on the put side, a negative $1 plus a negative delta, we've got a negative plus a negative, that equals a positive. So it would increase our put premiums for those corresponding strikes, okay? So pretty simple there so far, right? All right, so then we move over. Gamma, easiest way to remember, gamma goes with delta, all right? We talked about delta, it's the first dollar move. Well, gamma is the second dollar move. So this is, we could say it's dollar number 2, all right? So on the second dollar, gamma goes with delta on these premiums. So when we talked about this, on that first dollar move, now let's just say we've got dollar number 2, so we're trading at 169.13. All right, so we've increased by now $2 on these on this underlying here, and now we've got gamma going with delta on that second dollar move, so another 50 cents goes into those calls. So right now we're looking at being 50 cents going into here. It's going to be basically 50 cents higher is 50 cents into the 89, we're looking at $3 and I'm doing a brain cramp here. $3.39. $3.39 on the bid, and then the offer is $3.48. Oops. Sorry. $3.48. Is that right? 50 cents. 50, yeah. $3.48. So on the second dollar move, this is on the delta move. This has the gamma in it. All right. So, and vice versa over there on the put side, we've got a negative delta. Well, on that move higher, right? Second dollar move higher, gamma goes with delta. Well, we've got a negative 50 gamma or delta. We've got a negative 50 delta plus a positive gamma. So a negative 50 plus a positive 5 makes that 45 cents. So that next dollar move higher, how it's going to affect those puts is that we're going to then see it go down by 60 cents. So now these bids would be, $2.30 on the bid, 60 cents out of here. We're going to be looking at $2.40. Okay. So same thing goes with gamma. It's a negative plus a positive, right? So it still negative, but it's only 45 then. Vice versa, if it was a negative move, negative dollar plus a positive delta, a negative dollar plus a positive delta makes that a negative delta, and the gamma plus the negative delta would decrease on these calls, right? So further out, that would be like a 40-cent move, and you can kind of see that represented there. Also, on the put side, a negative $2 move, negative 2 plus the negative delta makes that a positive delta plus the gamma. So the next one, the gamma starts adding into the delta premiums there, okay? Everybody pretty clear so far? All right, cool. All right, so theta. Theta is the impact of time on our premiums. Theta, what we used to call it, is the thief, all right? So the thief in the night that comes and steals our premiums, theta, the thief. It impacts our premium very similar to what we saw in delta and gamma, although theta is always negative. We can't go back in time, all right? So it is always eroding our premiums. So you can see that theta in this column here and over here, we notice that both of those are negative, right? So time always erodes our premiums. We can't stop it. Now, further out in time, theta is a little less aggressive, okay? The closer we get to expiration, it starts picking up steam. And inside of 35 days to expiration to about 7 days to expiration, 50% of our premiums are lost, okay? So over time, okay? So we get a massive reduction. If we looked at 100 days all the way down to 1 day, we would see a 50% reduction just happen in this 35 to 7 days to expiration. So a pretty massive drop as that theta, just as the theta component. And I've got a graph we'll show here in a little bit to re-emphasize that a little bit later. But theta is always a negative to our premiums. Now, what I want you to get those levers and pulleys going, right? We know that delta affects our premiums, right? We know theta affects our premiums. Delta increases as we go directionally higher, all right, in the calls, and it decreases in the puts. Well, you need to start thinking about how you can take advantage of all of these things, right? Like if you were bullish and you could either buy calls to take advantage of that delta increase, right? Or you could sell puts, because as the market goes up and away, those put premiums go down. If you sold puts, you want to sell them high and buy them low. Similar to theta. You know, if we wanted to take advantage of theta by selling premium, we would want to go to closer duration, right? Like inside of this 36 days to expiration that I was talking about. If we want to limit that theta, decay, because we're thinking we want to buy calls or something like that for a bullish market assumption, then you would want to limit that theta going further out the curve, okay? You know, somewhere outside is 70 plus days to expiration. Even if you are a shorter term trader, like if you were just thinking, I want to do this for maybe 1 or 2 weeks, it would behoove you to get out there in time to take advantage of that theta component being much less aggressive further out in time, okay? So levers and pulleys, if I'm thinking I'm buying premiums, I want to get out there in time. If I think I'm selling premiums, I want to be closer to expiration, right? To take advantage of that. Because we can offset some of the other risks, like being wrong. Like if our directional assumption was to be bullish and we bought calls, well, we want to have enough time to be right. So go out there in time to be right, increase our chances there and limit what theta will do to our premiums, okay? And vice versa, with this being a bearish assumption, you know, we would be thinking we want to do the opposite of that, like sell calls. If we were selling calls, we would want to take advantage of that premium decay. And if we were buying puts for a bearish assumption, we would want to be limiting that theta component, okay? Because if we are buying puts, the market goes down, those premiums increase, right? Because negative dollars to a negative delta makes those positive deltas going into our premiums, okay? So theta just ticks away at it, but just know that out here in time is going to be much less aggressive to our theta component. All right, so Vega is one of the most important Greeks to understand, you guys, and it's actually not even a Greek. This Greek symbol is stolen from Gamma. You know, just to have full disclosure, Vega is not a Greek. It just they probably came up with the V because of volatility. So Vega measures the change in volatility. Excuse me. So what we're looking at is volatility, right? Right here, Vega, it's positive on both the calls and the puts. So what this is assuming is this increases by 1 percentage point. So we go to 1733. And how does that 1733, an increase of 1 percentage point to Vega, how does that increase our premiums? Well, 1 percentage point would go into our premiums by 21 cents in this case, okay? Same here, it would go in by 21 cents into the overall premiums. The underlying hasn't changed. We didn't move a day. We didn't even move a second. Oh, basically, it just upticked by 1 percentage point. Those will increase by 21 cents. What if it increases by 2 percentage points, right? Well, then those would increase by 42 cents. Vice versa, what happens if it goes down by percentage points? It goes down by 1, then a negative 1 plus a positive Vega makes that negative to the Vega, all right? So it'd become a negative to it. So if volatility starts going down, then that would start making our premiums shrink, right? As that price comes out because it's negative, all right? So wheels and levers and pulleys going right now, right? What do we need to think about? If we are looking at volatility, volatility gives us a signal as to whether or not these premiums are expensive or cheap, right? Now, this number doesn't tell me anything, to be honest, whether or not we have to know it's 16% for TLT, high or low, and we will talk about that in more detail a little bit later. But the idea is volatility gives us a signal as to whether or not these are cheap or expensive, right? And if they're cheap, then we'd probably be wanting to buy them. And if they're expensive, we would want to be selling them. Now, there's also this whole thing of Well, if volatility is kind of mid-range for this specific underlying, and I don't know if volatility is going to go up, and I don't know if volatility is going to go down, how can you take advantage of that? Or at least limit those risks of the unknown? Well, the way to do that is to buy one and sell one, right? Because then you can see that those premiums would be offset on the ones that I sold versus the ones that I bought. That volatility going up or down will be offset on the two different contracts that I own, right? If I bought one and volatility goes up, that's going to help me because I bought it lower than where it is now. It's going to hurt me equally on the ones that I sold, though. So we can offset that, right? And we can basically offset the theta also, right? And if I bought it, that theta is going to hurt me, but the one that I sold, that theta is going to help me. Because this premium goes down, that hurts. This premium goes down, that helps, all right? The ones that I sold, it helps on the downside. Sometimes I get a little bit caught up in doing the video, so if you got the video, it may make a little bit more sense on what I was just talking about there. But basically, the one I bought, the theta hurts me. On the one I sold, the theta helps me, and vice versa, the Vega is offset as well. So we can, if we don't know where volatility is going to go, whether it's going to go up or down, we can basically go and offset those. All right, so let's get into it. Where are we going? All right, we're planning a trip. We're trying to decide where we're going to go, and I'm going to say we're going to go to Microsoft. All right, so that's down here. Microsoft, and let's just say we're right here. So where are we going? We're starting out here. We're going to head to Microsoft. That's obviously looking like it's lower than where we are currently. So we're kind of looking at the bearish market assumption. So I've come up with a bearish market assumption by looking at the map or our roadmap here and decided that if I have a bearish market assumption, I'm starting out here and I believe Microsoft is going to go to here, right? So I'm obviously going to kind of take this kind of assumption where I believed I've charted it out with my Fibonacci's and whatever, or maybe this is a simple moving average, a backwards map or a backwards chart. But anyway, we've decided we've got a bearish market assumption in this, all right, in Microsoft. Now, the next thing I need to do, so I've come up with my assumption. That's like the first thing you and I do. We look at stocks. Maybe you're just looking at charts. I mean, I don't even look at the names on what I'm doing. I just kind of flip through my watch list and start looking at the charts and find those bearish assumptions. Sometimes I actually find them from, maybe watching TV or hearing some news about what's going on. Right now, basically Microsoft just came out with earnings. I think they've had a nice run with this whole stay-at-home kind of scenario, and I just saw yesterday LinkedIn's laying off 1,000 or so employees, which I would have thought that with a bunch of people unemployed that would be pretty good. But the problem is that employers aren't looking for people right now, so they're not doing the ads and everything. So that's going to hurt them. Is it going to really affect their bottom line? No, but it's a headline news right now, and that could cause them to at least correct. I think that these parabolic moves that the tech sector's had right now, there's people itching to cover some trades. They want to, anytime you're up that much, stress levels start building up. It's not always when you're losing money that your stress level starts going up. Sometimes when you're winning and you are like stealing money in a sense, it feels like, because you've done so well on this trade that you are dying to cover some of those and take some money off the table, right? And I feel like that's probably what's happening right now in the NASDAQ versus the, like the Dow Jones, that it's had to run much more parabolic than the rest. And I think that it's going to lead to, on the correction side as well, a little bit to the downside. So I think that some of these techs might be a little bit overdone. And that's my assumption. I might be completely wrong, you guys. So don't always follow my trade. I am not one to say that I am going to give you guys trades. I don't do trade recommendations. I don't believe in that. So one thing we talked about here, is it a good destination? And what I mean by that is, are there a lot of things going on? You know, are there a lot of eyeballs? Are there a lot of things to do? Are there a lot of people there? Yeah, you might be saying, I want a social distance right now, but that's not really what we're talking about. I'm talking about, we need to know if there's a lot going on here. Why? Because we need to see that there's a lot of things for us to do. We don't want to go on vacation and not have anything to do. Well, this correlates very nicely to the markets, because is there a lot of things to do? Are there a lot of things going on here? Correlates to volume and open interest. All right. You can see the Qs have a lot of volume and open interest going on any given day. A lot of open interest, a lot of volume. That's actually weeklies, but even in the monthlies is what we're looking at. And you can see I have a position in the Qs. I'm not trying to get you guys the limbing off the cliff with me. But what I'm talking about here is there a lot of volume and open interest. And one of the things that we need to do here is take a look at any stock, and this is an ETF. It works for ETFs. It works for futures. It works for just about everything here. Is we look at the stock. Look at that price, all right? So any stock that's over $100, which this is, then we move the decimal 3 ticks to the left, 1, 2, 3, right? And we're looking at 25 to 26 cents, right? 25 to 26 cents is what I come up with by moving that decimal over. So what we need to do is then go down here and look at the puts and the calls, all right? At around 30-ish days to expiration, 35 days to expiration is what I usually say. Closest to that, yes, it could be 40 days or 30 days, but basically we want to look at the closest to that 30-ish days, okay? Because that's where the time and volume's at. That's where the most eyeballs usually are, and it will correlate, or volume will roll out there in time to the further duration ones if it fits this rule. So you can look at volume and open interest here as well, but a quicker, you know, I'm trying to always streamline your process, you know, come up with easy ways. Thief in the night, you know, delta is data, gamma goes with delta, Vega is just volatility, those types of things. So what we want to see is down here at the bottom, if it's going to fit that rule as to whether or not it is a good destination. So on a stock that's over $100, we move the decimal 3 ticks to the left. And if it is under $100, then we want to, if we look at it under $100, basically, that's not a very good example. Let's look at Pfizer. And this is during open market operations. These just out of the money or right at the money should be basically 10 cents wide. And after the market, everything closes or everybody's orders gets canceled. These will get a little wider after the market. So if you're doing your, you know, looking at your strategies after the market, you need to make sure that this rule fits during open market operations. Okay, so is it a good destination down here? One thing I always say here is that what we're looking at with this strategy is that, I'm going to go back to my previous, I'm going to go back here. Is it a good destination? All right. So we'll go here and we're going to say, is it a good destination? We need to look at it like, you know, it's a stoplight kind of thing, right? So we've got our stoplights here. Green light would be, you know, if it's less than or equal to 10 cents wide, all right, on a stock that's less than $100. Stocks less than $100, less than or equal to 10 cents. That's basically a green light. A yellow light would be 2 times the rule. All right, so that's a yellow light. And a red light would be 3 times the rule. Okay, All right, and then what did we talk about? It was the ones that were greater than $100, right? We moved the decimal, move 3 ticks. I don't know, 3 ticks. All right, so 1, 2, 3, right? So, you know, and on $1,000 stock, right? $1,000 stock would be $1 wide. All right, so 2 times the rule, yellow light, 3 times the rule, red light. And that's really to give you guys, especially for newer options traders, a guideline as to whether or not you probably should be playing around with the options in there, right? Because as volatility expands, especially, you can see those get really wide. The other thing is if you're not used to the option pricing and stuff like that, and there's only one cat in town making markets, well, if you go to a farmer's market and there's only one guy with apples there, well, he's probably not going to be too interested in negotiating. But if basically 90% of the people there are selling apples, he's probably going to be thinking he's got some wiggle room on his pricing, right? Well, the same thing goes in options trading. When free market price discovery is in full swing, you get better pricing. If there's only one guy trying to, you know, trade with you, you're probably going to have to go to his price. All right. So if you have to give up a lot of edge to get in and a lot of edge to get out, well, that eats into your yield. That's some fat we don't want to have to deal with. All right. So make sure you're getting involved in underlines that have a lot going on in them. All right. And that will help you avoid that pitfall. All right. So what's the right environment? Now, the environment, whenever I'm talking about that, I still talk about it even when we're not talking about roadmaps. The environment is what's going on around this destination or this underlying, right? An environment is volatility, okay? It's really how volatile, what's going on around it. And you can kind of think of it as, if it's low volatility, it's sunny, you know, there's no stress on the road, you got no worries, you can take the side roads, you can stop, get out, stretch your legs. When it's rainy, you kind of want to beeline there, get there fast, right? So low volatility, we want time, all right? So we're going out that curve that I talked about, longer duration. High volatility, we want to get there fast. We're thinking low duration. We don't want to spend a lot of time in the car getting to our destination, right? So we want to beeline it there if you were looking at high volatility. But what if we don't know what volatility is going to do? It could go up, it could go down, or it's right at middle of the road for implied volatility. Well, then we need to start thinking, especially if this is what we're thinking, we don't really know, or we don't care. Like we don't want volatility to affect our strategy or what my thinking is on this underlying. Like I think I want to track this underlying dollar for dollar as to how it moves, lockstep, up, down, just like you would own the stock, right? If you went out there and bought or shorted a stock, you are playing that for dollar moves. All right. Same with this strategy, which we kind of put up on that shelf. The idea here is I want to offset volatility. I don't want to worry about volatility because I have the assumption I want to follow this. I have a really bearish assumption and I want to follow this straight down. Okay. So you could have that in mind. And I'm just going to really quickly run over to implied volatility, because what we were talking about with this one is this volatility. Like now we're on to Pfizer. So 34.67 for Pfizer doesn't tell me anything about these premiums, other than for every dollar it goes up, I know my premiums are going to increase by the volatility coefficient. That we know. Every dollar down, we know it's going to go down. But what it's not telling us is, are those premiums expensive or cheap? Well, what we do is we go down here and look at the chart. Really is what we need, is a chart for this. Or, you know, I have the the code that goes in there to create this in your watch list, and you can see I have mine listed from implied volatility high all the way to the low, because that's how important I think it is. I mean, when I'm looking at option strategies, as a matter of fact, or flipping through charts, I don't even look at the call letter or anything else. I'm looking at this. This is going to be the thing that really determines whether we're buying underlyings or option premiums or selling that underlyings options premium, okay? So what we need to know is that volatility coefficient high or low? And right now we can see it's 34, 35, something right, 34-ish, 35, 34 and a half. But when we look at this chart, we can see that it is, you know, kind of low. But what we want to do is, if you want to figure out exactly where it is, you take where the current IV is, current IV minus the low IV, all right, and you take that sum and you divide it by the high IV minus the low IV. All right, so on this chart, you would basically be picking these 3 points right here, 1, 2, and whatever that low is right there, okay? So, you know, it's probably like 18 or something like that. We could call this like 85. We could say it's like 85 up there. We know this is 34, and we could say that this is 18. So now we have all of our numbers to punch into this, you know. So we'd be looking at 16 divided by 67 or something like that. Ultimately, you should come out with something like it's in 25 percentile. Now, my rule is basically if it's greater than an IV percent, if IV percent is greater than, or sorry, let's say less than 50%, then basically you want to be buying premium. And if it's greater than 50%, you're going to be looking at selling premium. All right, selling premium. All right, selling premium or buying premium. All right, so that's how we determine really how pricey these option premiums are. If it's IV percent of above 50, we want to be selling premium. If it's below 50, we want to be buying premium. All right, so if it's below 50, if it's like in the teens or, you know, 5% implied volatility percent, that means it's super low. I want to be buying it. What's the day of the expiration we're going to be looking for? Further out in time, right? We want to get out there in time to take advantage of low volatility, low theta. And what did I say? What happens when volatility expands? It affects the further duration options more than the nearer duration options. So putting all this together, you would, when you're buying, you want to get out there in time as well, because the volatility helps you. You're buying cheap. You want that volatility to offset maybe some of that theta. Vice versa, if you're selling premium, you want to catch it when implied volatility is super high, and you want to take advantage of that theta component. And if you get that volatility crush, you'll see it really come out of those front months very quickly as well. So you can take advantage of that. All right, so that makes sense, right? We're kind of, you guys kind of getting the gist of this right now? I kind of probably already explained why does volatility matter? Well, because it really determines our premiums, right? It's really telling us that if volatility is high, we sell premiums. Volatility is low, we buy premiums. If we're buying premiums, we want to limit theta decay, and volatility affects further duration. We get out there in time. We take advantage of all that stuff. Now, that being said, we are thinking, okay, now we got all of that. What's our duration? Well, right now I kind of said, I don't know what volatility is going to do with Microsoft right now. I'm worried that it could go up or it could go down. If it goes down, if the market goes in my direction, I could see volatility increase, but it could start just, you know, slowly trickling down, and therefore you're probably not going to see very much volatility increase at all. You could actually see volatility coming out. And so you know, I want to offset that volatility, but I also want to take advantage of this market going down. And I want to give if I can offset volatility, I'm offsetting theta, right? Because buying and selling, we're basically offsetting theta. We might as well give ourselves enough duration to be right. Even if this is only going to be in play, we're only expecting it to be in play for the next week or two. You might think, why do I need to go out there and pay up for that? Well, actually, we're not going to be paying very much for this strategy. We're going to try and do this for a credit anyway. So that will help us. But we want to try and get out in time and give ourselves enough time to be right. Plus, because we're going to be trying to do this for a credit, it can help us out a little bit faster. So my thinking is, remember I said I want to offset theta. I want to actually offset theta and Vega because I want to track this underlying for a longer term. I want to take advantage of it. I'm going to take Route 66. I'm not beelining it. I just want to take advantage of this move. It's kind of like my overarching theme on Microsoft right now. I want to spend some time with this trade. I want to be able to hit all the destinations on the way, all of those different spots along the way. So I want to give myself enough time to let this whole trade work itself out. So we need to decide what spots are we going to visit. And I was going to throw in some old pictures of me hitting all these basically different stops. I'm a tourist trap junkie when I go on road trips. So we're going to try and hit at least a majority of these stops. Well, what we want to do is we want to basically kind of build our strategy. And we're going to be buying an out of the money put, which is, you know, lower down the marker. And we're going to try and buy about a 25 delta put, selling a 25 delta call. So let's think about this. The delta put, I'm buying a 25 delta put. That is a negative 25 deltas, right? Right? Because deltas are negative. And then I want to sell a call that's a 20 delta. So I'm selling a call. I'm buying the put. If I'm selling that call, it also makes those deltas negative as well. So I'm negative 25 deltas there. That all adds up to negative 50 deltas. Okay, and that's the risk reversal. So the reason why this was called a risk reversal was because most of us are thinking, you know, we have like 100 lot in our portfolio. Okay, so this is a good way to limit, like if you didn't want to take capital gains taxes or take capital gains against you, have to pay capital gains taxes or something like that. Well, this is a way that you can kind of offset some of that downside risk. If you were long Microsoft and were like, I still want to capture some of the upside, I'm a little worried about the downside, I don't want to get a stop in there or any of that stuff. Well, you could put on a risk reversal to basically get you out of half of that 100 lot position. And because it's got, you know, a bid and an off or a put further out of the money and a call that's further out of the money, you know, that gives us a little wiggle room that if it was just kind of trend sideways, it wouldn't necessarily hurt us. Okay, so at least at expiration. So ultimately, this is a play on a portfolio. But what you can also do is trade this as if it is an underlying, but instead of doing 100 contracts, right? Because if you shorted 100 of the underlying, that's negative 100 deltas. Well, if you shorted the underlying and you only wanted 50 contracts on because, you know, maybe it's too expensive, you want to limit some of your margin, you don't want to take that much risk or whatever, then you could limit it to making it only for every dollar down or every dollar against you, it only affects your strategy by 50 cents. Okay, so we'll be able to take advantage of that way. All right, what about the thief in the night that comes and steals our premium? Well, that thief, this is what I was talking about. This is that 35 days to expiration where we really see that theta decay. But remember, here's our key. We're selling a call here and we're buying a put. Well, the put's going to get hurt as theta comes out. Well, the call is going to be offsetting that. All right. So you can see that they pretty much run together pretty closely. And we are doing out of the monies, and this says at the money. And yes, the curve is a little bit different, but you get the idea that we see a lot of theta decay happening inside of 35 days. So one of those things is we got to be aware of that. And I talked about this is kind of like the sweet spot that I like to look at, is just outside of that 70 days ish, because I want if I get in here to have at least, like this much time to be right? I want to kind of get in here and have this much time to be right where I can limit some of that theta decay before it really starts falling off the cliff. All right. So I want to give myself enough time to be right there. All right. So getting out in time. So what vehicle are we going to use? Well, I kind of gave it away. The bearish risk reversal. We're taking it off the shelf. The bearish risk reversal we talked about is buying that out of the money put and then selling the out of the money call. All right, so a couple of things with the bearish risk reversal. It is similar to the risk reward of the short stock. Short stock is assuming a 100 lot underlying. It also, one of the beauties of this is you don't have to pay the dividend. When you're shorting a stock, you actually have to pay the dividend because it's assumed you're receiving it. Also, it is less capital intensive than shorting a stock. When you go out and short a stock, you have to borrow the stock. You have to pay maintenance on that stock. And when you're shorting, the margin requirements are higher. So this uses about 50 to 75% less capital, which is ultimately going to increase your overall return on capital. Because if you're using less capital for the same result, then you're using less return on capital. All right. So we've talked about this direction. We're bearish, right? We've talked about this. We're a bear. Destination, we've checked that out. What is that? That is the less than or equal to 10 cents wide, or we move the decimal. Des, 3 ticks, 1, 2, 3, right? Decimal 3 ticks. All right, the environment, we're offsetting this. We don't want the environment to affect us, all right? So this was our decision-making process. We want to avoid dealing with implied volatility percent. We don't care if the premiums are expensive or cheap. We want to just kind of offset that. Also, the duration, because we're offsetting volatility, we also are offsetting theta. We just want to get out in time. So we kind of want to be greater than, I would say at least 70 days to expiration, okay? And the strikes, we want it to equal 50 deltas, or at least close to 50 deltas. You're not ever really going to often get it to be exactly dead on 50 deltas, right? Sometimes it's like 53, sometimes it's 48, whatever. At the end of the day, we're just trying to pick those 25-ish delta strikes, make it done for a credit, all right? We also want to make it equal to a credit or zero money. Zero outlay of money. All right. Why? I'll talk about that here in a second. Why do you want a credit? I'll tell you. All right. Our max profit is the underlying goes to zero. No, I would not suggest taking this strategy to the end of the day where the underlying goes to zero, especially in an environment where companies are getting bailed out. But if you think there's a correction, use your judgment as to what you would normally do, how you come up with a bearish assumption. You have targets. If it gets down to this Fibonacci, that's where I'm out. If it drops 10%, I'm out. All of those things. What I emphasize in my daily market commentaries, practice what I preach in those as well. But in these you know, I can't tell you where to get in and out of trades, all right? I can't tell you what you should be getting long or short, all right? Why? I don't know your risk parameters. I don't know what's in your portfolio. What I and your directional assumption could be just as good as mine, you guys. So take that to the bank, all right? But know and go through the process of writing this stuff down, making sure that you have the data to go back and look at as well, because you know, we all have a tendency to look at bad trades more often than we look at good trades and keeping track of those. This will, if you're writing it down where you got in, you got out, you'll be able to have the data there right in front of you to give you confidence to continue with different trades. All right, so max loss is unlimited, just like if you shorted a stock. If you got short a stock, unlimited risk to the upside, and the underlying goes to zero. Vice versa, if you got long a stock, you know, you still have unlimited risk and reward as well. All right, break evens. Why not pay a debit? Because we are, when we're paying a debit, it's our put strike. So if the underlying's here, if the underlying is trading right here, and our put strike, you know, is we're long puts down here, and we're short some calls up here, right? Well, if my break, what would you rather have? Your break even here or your break even here? If right now we're currently XYZ is here and we want it to go down, right? I want my break even up here, right? You want your break even above where you're going, especially if you've got a bearish assumption. If you got a bearish assumption, yeah, you break even below you. I mean, that's your target anyway, right? But what happens when things don't work out? We're not always picking the right directional move. Give yourself the room to be wrong, okay? Having that break even up there at the call is giving yourself a better probability of success, all right? These are things you don't find online, you guys. When they're talking about a risk reversal, they're not going to talk about these nuances. They're not going to be telling you. They're just going to be telling you the break even is the put strike price minus the debit, the call strike price plus the credit. They're not going to say you should really consider doing this strategy, like shaking you for a credit or zero outlay of money. Because if it's zero outlay of money, then it's still basically up here at the short call, right? So try and build this out for at least a slight credit. You build it out and it says it's a 3-cent debit, right? Well, just move it up to zero and try and get that trade there, or a couple of pennies in there, because it's the call strike price plus the credit paid. So if our call strike is here, then our break even is slightly higher, right? And if it's the put strike minus the debit paid, then our break even is actually slightly lower. So we have to make that move happen to the downside. All right. All right. So finally, exit. Write this stuff down, right? This is what we do when we're not necessarily what I'm writing down right now, but when you're building out this, you come up with the assumption, you write down, you got a bull bearish assumption. XYZ is the underlying. What is the environment? What days to expirations did I pick? What strategy is it? And in this case, we are taking Microsoft. So I'm taking Microsoft to, I think it's basically going to, I think it's 295. Maybe it's 195. Can't remember exactly it is. But so where are we getting out on a winner? Basically, it goes down to my, 180, 195 area. On a loss, I'm going to look at the chart here and just say, like, if it goes, and I think I'm way overpricing for some reason. I feel like it's 195 right now, and I'm having a brain cramp. 195 is where I'm looking at. So 1 day chart. So basically, it's $200 that I think it's going to break there. I think it's at least going down to, let's say, this Fibonacci. That's my thing. And if it comes down to this volume node 185, I'd be very happy. So I'm looking at those 2 points to come out. Now, obviously, I need to know where my out is. My out is if this is trading above, I'm going to say 214. So this is 195. My target is for a winner trading at 195, and right now it's trading 205. I don't know what we want to even call it right here, but whatever. 195 is kind of like a winner. 195 to 185. I got to pick one of those two. And then on a loss, it goes above 213, 214, something like that. That's where your exits are on this strategy. So write those things down so that you will follow. You'll be more mechanical. If you put it in your brain where I'm going to get in and out in a week or two, and that happens, you are much more likely to kind of talk yourself out of it. Well, maybe I'm not going to do that. It looks really good. What happens? It's going to turn around on you. It usually does. All right. May not. It may or may not. But the fact of the matter is what I want to implore on you is when you're trading, you need to be mechanical, you guys. I don't want you guys going out there and there's emotion tied to money. And if we can pull money away and forget about it as money, I mean, that was actually one of my first lessons. A trader asked me one time how I was doing on the day, and I basically gave him a dollar figure, and the guy's head just was like, dude, I'm so disappointed in you. You know, until you are not thinking about money and you're thinking about levels and stuff like that and probabilities, you aren't a real trader, okay? And the reason why the best traders are good at trading is because they take the emotion out of trading. They aren't thinking about it as trading. That's why a lot of these people come up with like different algorithms and stuff like that to, different algorithms to place their trades because they don't want the emotional attachment to it. A computer doesn't do that. It's like I'm in or out, winner, loser, boom, boom. No thinking about it, right? Same thing. When you write it down, you're more accountable to yourself, all right? You're making sure you're following those. Hello, will there be a recording? I'm on a cell phone at work right now. It is a little hard to follow. Okay, Doug, I appreciate your dedication, Doug. Yes, it is being recorded and this will be sent out. So make sure you can take advantage of that. So today on XLU, when someone bought a put at the 45 delta and sold the 42 delta call and paid 30 cents, it was bearish. Bought the 45, yes, and sold the 42 delta call. Yeah, they basically did a risk reversal also, and they're doing it for 87 deltas, right? Yes, they did. And they did it wrong because they paid a debit, right? They paid 30 cents. Their break even is way down there at the puts. Like I said, when you are getting free education on TV, then you are getting just that. You know, you're learning it for yourself. So bottom line is try and build this out for a credit. All right. It's a little bit more difficult with the puts because they're usually a little bit more juicy with the premiums, but it can still be done. You're not exactly picking a 25 delta. You might be picking like a 21 delta put and a 27 or 28 delta call, okay? But at the end of the day, and we'll go over an example here in just a second, make sure you do it for a credit. Those guys on TV don't know what they're doing, I'm telling you. I mean, even my friends that trade options, I just do the SMH or whatever. I'm shaking, or SMH, just shaking my head. My kids always do that. Because, why wouldn't you do it for a credit? Pick a couple of different strikes to make sure you got a credit if you are wrong and it just stayed right here, you aren't going to lose money. That is what I couldn't understand since there were 3,000 contracts and must have been a professional. Well, the idea here with a professional is, yes, what he is doing is he's thinking, the market's made a big run. He probably doesn't think it's going to make much more of a big run to the upside. It actually could start trading a little trending sideways here. Maybe he's thinking it's going to stay between those strikes for the foreseeable future. So what he's doing is he's doing this risk reversal to hedge some of those long stocks in his portfolio. But if it falls out of bed and goes below his strike, then he's starting to be protected on that strategy, right? So that's a real true sense of how the risk reversal is named for that, is because your risk is bullish in an overall portfolio. So you can do the bearish risk reversal and take some of those positive deltas away. And with this one, you're not just doing a synthetic short, which would completely counteract anything your strategy did in your portfolio. With a risk reversal, also the beauty is you have that wiggle room between the call and the put, that if it bounces in and around here, you're not losing money, right? This guy is actually, the guy in the example is, because he paid 30 cents for it. He actually increased his overall cost basis on this trade. If he had done it for a credit, he would have lowered his overall cost basis on the trade, given him the wiggle room all the way up to the calls, because now, he's got to get down to the puts, which is counterintuitive to his strategy probably anyway. But at the end of the day, he made a mistake and did it as a put. So the idea is if it started trickling down like that, then, he starts really covering his position to the downside. Does that make sense? Okay. He still set it up wrong, though. There you go. Professional trader blowing it. Oops. So I want to pull up the platform here because I want to go over an example real quick. All right. So are we bearish Pfizer? I was going to look at Microsoft because Microsoft, I think, is ready to make a bit of a correction, and it's got those different moves. We could look at, whether or not I don't know if I have a Fibonacci up. Yeah, should Fibonacci it. All right. So, well, that kind of lines up with that 196 area, 184. So I'm going to say 184 is kind of where I think it might retrace to 196. In this case, I think it might go down to this volume node, but what I would say most likely is that, in a trade like this, I would take off half my position right here and then the other half to here, okay? Because I think it's gotten a little overdone to the upside. I don't know if it's going to make it all the way down there, but I do think it'll at least make it to the 196, and then I'm going to be out above there or something. All right, so we're going to go over here. And another thing is, when I'm coming up with this, I got a bearish assumption with this. I'm looking at implied volatility. Do I think it's going to go up or down? I really don't know. If it goes, market really sells off quickly, volatility is going to go up. But if it trickles down over the next month or so to get there, then volatility is probably going to come out. It's going to hurt me. So what do I want to do? Well, I'm going to come up with a strategy. I guess I'm going to probably want to isolate volatility because I don't know if it's going to go up or down. So therefore, I'm going to look for the risk reversal. Maybe you have Microsoft in your portfolio and you want to hedge that portfolio as well. So, whoa, these markets got really wide after the close. Not even fitting the 20-cent rule. These were like 10, 15 cents wide during the open market operations. Oh, well. All right. So I'm going to pray the middle of the market's going to work for me. I'm going to buy this buy this put, right? Negative 27 delta. I'm kind of looking at middle of the road. So 22 delta is probably, actually, I'm probably going to go the 180s for this one, buy those 180s, 20, and then go to selling these, okay? See how I did that? I went a little bit further down on the puts and made it 22 deltas because the premiums are a little bit cheaper, and then I went a bit closer on this one by selling the 27 delta call. This was where I was talking about there's put skew, and that means volatility is kind of rolled, or premiums rolled into the puts there. So in this case, we're going to need to finagle it a little bit, all right? We need to massage it. All right, so that's how we do that. Now, you're saying it's not 50 deltas. Well, it's not. It's 49. It's very close, right? Close enough for government work. But the key is I'm doing it for a credit. So now my break even at expiration is 225. You know, if we go over and look at the Analyze tab, we'll look at the difference here. So let's look at the Analyze this trade. Get rid of this old trade. All right. So you can see that it's got this flat mark here. And this is all about expiration, right? And Banu, this is where I was talking about, you know, that guy's trying to play it right in between here. He doesn't want to lose money, you know, if it trades right in here. And that's probably his thinking, is it's going to trade within a certain range. But if it does correct, then he wants his downside to be really protected, okay? And I think a lot of people are starting to do this just right now if they're not covering trades. But look, right here is this marker. See that little red line right there that I'm covering up every once in a while? That is my break even to the upside, all right? Now, if I do this, watch, I'll just make it a debit. You can watch that you see it just flip? Let me go back to a positive. All right, so now watch, when I go to a debit, my break even is down here. All right, so that means it's on the puts. Well, that's what that guy did. Like, the underlying is trading right where we currently are, then he's got to make up some room or he's losing money on this trade. Especially if he thinks it's going to stay within here. He should have just finagled those strikes just a little bit to make sure he got himself a credit. That makes sense? You know, I mean, just that little bit, 1 or 2 cents. I mean, that's a big difference. Boom, boom, bam. 4-cent swing. Boom, boom, boom. That makes your break even move by $40. All for 30 cents. Shaking my head, Banu, shaking my head. All right, so make sure you pick those out. What's one of the biggest things to come back from this? Do this strategy for a credit, all right? Try and build it out to do it for a credit. All right, this is our offer for today. Without any further questions, if you do, I'll try and answer them again after all of this. But Option Lab course, or Option Lab right here, get you instant access to the Wolfman Options course. All right, 100 hours of content. You guys can take as much time as you want with that. You can check them off also as you go through it. It will show you which ones you've watched. Something I always mention about my webinars is watch them again. I know I throw a lot of content out there. If I wanted to tell you how to do a risk reversal, a bearish risk reversal, I could have just told you, hey, you out of the money call, out of the money put. That's it. You're on your way. No, there are certain things we need to know about this to increase our probabilities of success. If I had a bearish assumption in Microsoft and I thought volatility was going to expand, would I pick this strategy? No. All right. It would have led us down a different road. Okay. What we're trying to do is increase your probabilities of success. And by doing that, we have to follow these guidelines that I lay out in these courses. All right. Which I've spent a lot of time to come up with. Also, it's 100 members. First 100 members is very close to being capped off. So make sure you get on that. Also, you guys are going to receive upgrades for different promotions that we have going on. So you'll be able to take advantage of those. Also, the question and answers, which means I am an open book. You guys have a question, reach out to me. You have access to me if you are taking advantage of the Options Lab, okay? Win, lose, or draw. I talk about my trades in the daily market commentaries, which you'll also get. But back to the question and answer, I have a no inbox policy. That means you guys send me an email. I'm going to answer you as humanly possible. I'm always at this desk. I'm basically going to be at this desk until probably 8 o'clock tonight. That's how much time I spend here. And I'm here at basically 6 o'clock at the latest in the morning. So I'm pulling over 12-hour days here. I'm accessing my email all the time. So I will answer your questions as to how I would approach the situation. I can't tell you guys how you would or you should, because I don't know your risk parameters. I don't know what's in your portfolio, but I can tell you, according to my guidelines, to keep it mechanical, what we should be doing, okay? So you get that for 97 bucks. I see your question up there, Ron. I'll get it here in a second. All right, and a bunch more. Some of that is the daily market commentaries I was talking about. It is in the chat window right now. I forgot to send it out. There it is. It's in the chat window. So if you click on that chat window link, it's a hot link. It should pull up a web page. Please do that now because, like I said, there's 100 videos over there. I don't have my page up, and plus I don't want to just scroll down. I mean, it's basically, I can't fit it on a PowerPoint slide here. So basically you guys need to pull it up to check it out. But there's hundreds of hours of content. And when I said watch this webinar again, you don't have to just watch this one again. Watch one of the other ones on a risk reversal. We approach those in different ways. If you're a newer option trader, go to the ones for options for newer traders, beginner options strategies. We basically start out with, crawling and then start to walking to running, okay? So I talk about beginner strategies, middle strategies, and then we kind of build on those to more and more levels of options, okay? So we kind of build it out that way. So if you're a newer options trader and you might have gotten a little lost with some of the things that I was talking about here, go to that one and watch it again, okay? Because we kind of structure them differently. I'm trying to do these courses in different ways because everybody learns differently, right? That's another reason why I'm throwing on the camera on this particular course, is because I think that, some people get more engaged in it, and maybe it helps out. All right, so Ron, I got your question here. Let me get back to this. Yes, somebody else asked the link at chat window. We're going back and forth in the questions box. Chat window is where we're at. If you are watching it on tape delay, though, you're going to have to pause and punch this into your URL. Have you sent or put the recordings of last week's synthetic short? It should be, Ron, but if you haven't been able to get it, reach out to us at trading@protraderstrategies.com. Also, if you have any questions, comments, or anything else, you can reach out to us at 310-598-6677. Ron, I'm not in charge of sending those out, so it could have gone to your spam or something like that. I don't know, but you can reach out to us and find out more information those two ways, okay? But I would have thought it would have gone out by now. It does take me, it doesn't go immediately out because I gotta break down the webinar. I've got to refactor it. I've got to upload it and then send it out to the marketing people to get it out to you guys, or not really the marketing, but the powers to be. KM said she received KM, I don't know if you're a man or a woman, but said that they received a copy of the synthetic short webinar, Ron. So if you didn't, reach out to us. All right, that's all I got for you guys. Other than, if you can't take that, take it easy. Take care. Bye for now.